Hi, my name is Craig Basinger, and I'm the Chief Strategist at Purpose Investments. And thanks for clicking on our May update entitled Past Peak Uncertainty. Certainly lots going on. April was a full month with obviously markets dropping and then subsequently recovering, uh, all as a result of policy uncertainty ramping up initially, causing the market pain, and then pivoting and becoming, well, less uncertain, and markets handedly recovering. This is our disclaimer. Please read at your leisure. So yeah, listen, this has been a bit of a policy or tariff gong show. I think that would be probably the best way to put it. After months, markets sort of held in relatively well, ignoring a lot of the policy uncertainty until, suddenly they didn't. It kind of started in March and really accelerated at the beginning of April. It turned out to be about the sixth fastest correction in history for the S&P 500. And went for a wild ride in April, but thankfully markets recovered near the end of the month and have continued to recover as we have moved into May. We would say, and we've said this before, even in our last presentation, that peak uncertainty is probably behind us on the tariff side, not saying that there's all that much that is certain or known, but it has certainly, it's hard to envision a more dire scenario than we saw at the beginning of April, which I think is good news for markets. And they've managed to recover much of the losses. Even the TSX, the TSX is actually bumping up against an all-time high. Meanwhile, the S&P is still a few points down, but certainly nothing compared to where they were at the beginning of April. On the bond side, bonds have been actually performing relatively well. I mean, listen, this market weakness began, bond yields came down, providing a bit of a stabilizer for portfolios. As markets have gone back up, bond yields have come back up. So, kind of doing what they're supposed to be doing, and then sort of the ballast for portfolios. The more challenging aspect has been the US dollar, usually a safe haven, but when the policy or when the market's angst is really focused on what's going on with US policy, the US dollar isn't much of a safe haven, as clearly was evident in the decline of the US dollar, falling about 10% against its a trade basket of its peers. It has started to recover since then with the market recovery and some better inflation data. Expectations for Fed rate cuts have been pushed a little further out, and that has enabled market to expect them to remain higher, which has put a bit of a bid under the US dollar. And I think that's certainly been a bit of a positive of late. And I think, we've talked about this before. This is all self-induced. This is all policy. It's been a long time. It's been decades, in fact, that we've really had to deal with this kind of policy angst in the markets. And it did happen many decades ago more often, but policy for the last number of years has been relatively benign up until recently. The good news with it is because it is self-induced, it can obviously quickly pivot and become more market friendly without much of a delay, and that's what we've sort of experienced. So now, with the uncertainty fading, what happens next? We sort of drew up this graphic a little while ago, but this was sort of our expectation for this year. And, to start off, we were surprised that markets remained resilient with the uncertainty around policy. And in fact, we thought there would be weakness earlier in the year, and it sort of waited until March and April. I'm not saying we expected what happened in April. I don't think anybody really did. But, a lot of it was somewhat expected. Probably the magnitude was a little bit surprising. And also, I would say that the recovery's been pretty surprising and possibly even going further than we had expected. But we had expected uncertainty around policy to weigh on markets at some point. And then as that uncertainty faded, whether it's good news or bad news, markets don't mind bad news as much as they dislike uncertainty. So as that's faded, we've seen this market recovery. But of course, now the question becomes what happens next? And, earnings are coming down. That could accelerate. And also the economic data could also, this extended period of uncertainty is going to have an economic impact. And we haven't seen much of it yet, which I'll touch on shortly, but that could change in the months ahead. And we think that could also lead to a second period of market weakness. And this is sort of our roadmap for the year. Again, like anything can happen. And markets can obviously, they're somewhat of mind of their own. But this is sort of our game plan. We do believe we're in that sort of bounce back off it with uncertainty fading. But at some point, we think the fundamentals are going to weigh on markets in the coming months. So let's talk about economic data. The vast majority of weak economic data has been on what would be called the soft data side. So soft economic data is surveys, either businesses or consumers, and investor sentiment surveys. And all of these are just very, very bearish, pretty much in the dumps. And this is captured in this chart. This is the Bloomberg Economic Surprise Indices. The thicker line, the aqua line, is the total aggregate. So it being close to zero is roughly neutral. But if you splice out the survey data, it's very negative. But if you take out the survey data, the hard economic data is pretty good. So hard economic data measures, not what people are saying, but actually what they're doing. And that has remained relatively resilient. So employment, retail sales, industrial production, all reasonably decent and not showing much signs of weakness. So which one is correct? Is it the survey data leading? That is our belief. The survey data, I think you still have to take it with a bit of a grain of salt, because people don't always, they'll say one thing, but they'll behave in another way. However, hard economic data does have a delay because it takes a fair amount of time for that data to be compiled and reported and aggregated. And the question is, is that hard economic data going to start to show weakness in the coming months? Because one, potential component, there has been some, strange behaviors on the consumer side and on the manufacturing side and on the trade side, that people have been, doing things to front run the risk of tariffs being implemented. So that might have brought some of that, more robust economic data and pulled it forward, which, regardless of what happens with tariffs, that may actually lead to another period of weakness on the hard data coming soon. So we've been talking a lot about sort of hard, fast data. So this is hard data. So it's not sentiment, it's not surveys, and it's measuring what people are actually doing, but it just has a higher frequency or is more timely. And so far, even the hard, fast data is not too bad. Initial jobless claims still relatively stable. So we're not seeing, this is a weekly data series, so we're not seeing much weakness there. But we are starting to see pockets of weakness, and a lot of it is actually in the travel and leisure space right now. So this is consumer spending, measuring credit cards and debit cards and where people are spending money. And as you can see, the consumer spend, that's the aggregate measure, which is that black line, 3-4%, pretty decent at this point, even picking up a little bit. But it's really interesting where it's coming from, because like electronics, appliances, hard goods, that spending has really accelerated. And a lot of people might believe that's because people are trying to get, these purchases done before any tariffs impact prices. Meanwhile, spending on air transportation has dropped considerably. And again, this is more of a, watching what people are actually spending money on. And that is not certainly a good sign going forward. Another way, even focusing on travel a little bit more, is on the hotel side. So this is just measuring, the amount of visits in hotels on a year-over-year basis. And, measuring from 3 months ago, you've seen a dramatic slowdown at the Hyatt. Even the Hilton went from positive to negative, and the Marriott from positive to negative. We threw in Sleep Inn and Super 8 just to show that, for quite some time now, the sort of the lower end or lower cost, or the lower income, where the lower income consumer probably spends money on hotels or accommodation, they've been in the dumps for a while, but it does appear that the higher end hotels are starting to see fewer and fewer visits. So this could be a sign that things are starting to slow down. Again, this is just a pocket. It's not pervasive, but we are starting to pick up little bits of economic weakness. And it'll be interesting if that continues to build, or if it sort of fades away as the uncertainty around tariffs fades away. Again, we're going to be watching this sort of hard, fast data pretty closely. We think that's going to be sort of the canary for what's going on in the overall economy. But so far, things are a bit mixed and not all that negative. So what happens next? Listen, we've talked about tariffs till the cows come home, but I will say that uncertainty probably has peaked and is starting to fade. But again, that can change at any point in time. And it is worth noting, with the S&P recovering, they may ratchet up policy that is a little bit market unfriendly again as markets have recovered, but time will tell on that. On the earnings side, we have seen, a lot of companies have pulled guidance. They haven't guided down, they've just pulled guidance. And estimate revisions are negative, but the magnitude isn't very material. So, worth noting, but not too alarming at this point. But that could accelerate. And I think if there's some clarity and if there's more evidence of a slowing economy, we do think that earnings erosion or negative revisions will accelerate. Finally, in the hard economic data, like I said, we're watching this pretty closely. The question is, with this extended period of uncertainty, is it going to leak into more and more of the economic data? It hasn't yet, but we do think that is a risk in the coming months. So from an asset mix and asset class allocation perspective, we're still a little bit defensively tilted. We're about neutral on equities. We're a bit under on bonds, but we are holding more cash and more diversifiers as our sort of alternative defensive allocations. Among equities, we are a bit underweight on Canada. We have a mild underweight now on the US because we did do some buying in April. And international, we have a pretty solid overweight, which has worked out quite well, as has our emerging markets exposure. So we're sort of neutrally exposed on the equity side with a bit of more of an international tilt. On the bonds, we are pretty low on the credit exposure, so we are certainly more defensive in our bond allocation, albeit we would point out that this is a bit of an underweight for us. And for our defense, we do rely a little bit more on alternatives and other strategies for diversifiers and gold and the like, which I'll touch on in right now. We've been a big fan of gold for quite some time, and we had a pretty big allocation that sort of continued to grow this year. It's been one of the better performing areas of the market. We did reduce our gold exposure at the end of April by a fair amount. We were at about 4.6, 4.7% in our multi-asset balance strategy, and we brought that down to about 3%. So we still like gold. We still want to have gold in the portfolio, but I'll be honest, like the last 2 months has probably been almost the perfect storm for gold. Weakness in the US dollar, huge amount of policy uncertainty, and that is why the price of gold went up so much. So we just thought it was time to sort of take some of those chips off the table after such a strong run. Now, I will not deny the setup for gold is quite positive. These are sort of, 5 of the buckets that drive gold, and, central bank demand is still pretty positive. Interest rate and inflation is ticking up a little bit. Again, that's positive. Geopolitical risk still certainly evident. Another positive. Dollar currency trends with the weakest in the US dollar, again, positive for gold. And now we did pick up over the last month and a half, a fair bit of buying at the ETF level, both international and in the US. Now, these are all positive for gold, so you're probably wondering, well, why would we sell? And the answer is quite simply, when they're all actually already bullish, it's really hard for them to become even more bullish. And in our minds, you have to sort of take a look at the backdrop of where things are and also the price that things are trading at. And with the price of gold touching 3,500, it's a few $100s less now. We just thought it was time to sort of take some of that off the table, and we did park it in cash. In our multi-asset, it has been a great year for us so far. We are top decile. We're actually top percentile year to date, which is fantastic. This is as of today, which is May 13th. So that's as of the close May 12th. And again, this is our sort of multi-asset complete solution that we manage. We are probably more defensively oriented, but this is an active strategy, and we do make changes quite often. I would point out, from a defense perspective, we are not just owners of bonds. We do own sort of other alternative type defensive strategies. Having a diversified defense, I think, is very important. And I think our approach to defense within the portfolio has really paid off so far this year, which is, again, what's helped our performance. We have a momentum strategy in there and our tactical strategy. We have some premium yield option writing strategies in there. And then obviously gold combined with our sort of bond allocation, which again is a bit underweight, but is certainly higher quality. Within this, I did say we are active, and a lot of the multi-asset strategies are relatively static in their allocations. They're sort of set it and forget it kind of strategies. We are a bit more active. We did some buying. We did some buying in April for the S&P 500, and we did trim some of our gold back then and some of our Minvol on the EFI side. And then more recently, we trimmed gold again and parked that in cash. So again, this is not a static allocation, static strategy. We do make changes. And if you're interested in these changes as time goes on, please, go to the Purpose website. Under resources, there is a platform for portfolio strategy, and you can sign up and get sort of our trade rationales when they come out, and also our why report, which really talks about our portfolio's tilts one way or the other, how we're allocated and why we're allocated that way. It is not really a marketing piece. It really talks about a whole bunch of different aspects within our portfolio tilts, some that are working, some that are not, but clearly shares our rationale on why we're positioned in one direction or the other. And if you do sign up, like I said, you do get our trade rationales shortly after we do make any changes in our multi-asset strategies. So again, even if you're not using our solutions, it might be a useful tidbit into your own process. So I'd encourage you to pop under our website. Again, that's purposeinvest.com, and then just go up into the resource tab at the top. And there is a platform it's under the platforms, and there is a section under portfolio strategy that has all this content and information about our funds and an easy way to sign up for our content flow. And with that, I will end it. And if you have any questions, please feel free to reach out to either myself or anyone on the team or your Purpose wholesaler. And again, thanks and happy investing.